the life cycle of a loan. So, a lot of people are interested in private money lending, but they're kind of like, but what does it look like exactly, right? Like from start to finish, how does it actually work? And so, in this video, we will cover from inquiry to payoff what exactly is happening, depending on the loan type, what happens between those steps, and then lastly, like why clarity matters early in the process and why you need to know before you get started what to expect depending on your loan type, your payment type, etc. So, inquiry to payoff, right? If you are a private money lender and you're new to this space, so you're like an individual, you're just starting, you're running your own company, you're really like a solopreneur in the space, your inquiry to payoff is going to look totally different than someone who is a hard money lender and doing institutional loans and has been doing this for 10 years, right? So I'm really talking from the perspective of me, right? Someone like me, someone like you, just starting, loaning out our own money directly to investors and business owners, okay? So for me, what that looks like is I have a landing page, very simple landing page. And on that landing page, it has a funding request form. Now, that funding request form is really just a type form that I created, and it's set up like an application, right? So it has all the information that I want to know from the borrower before I decide if I want to move forward. Now, if we think about even before this, like how does someone even get your landing page or your funding request form? In private money lending, it is a very relationship-based business, right? So typically I've already met the person, I've already had a conversation with them. I probably know them through an acquaintance or something. Someone has referred them to me. It's usually a warm lead. I don't have my form just like in a bunch of random places, right? I don't have my landing page in a bunch of random places. Typically, private money lenders like to know who they're dealing with, right? So, because this is our own money. So, that's one of the ways that we manage and mitigate risk is by understanding who the borrower is, building a relationship with the borrower, etc. So typically I'll have met this person or someone that I know have met this person or can, vouch for their work. And then they'll tell me, maybe a friend will text me and say, hey, like I know a fix and flipper, or I have a friend who's doing fix and flips in Texas and, they're looking for funding. Can you help? I'm like, oh, okay, cool. Like send them my landing page or send them my form, right? Okay, so the borrower fills out the form and then I get a notification. So I've set up my form in such a way that every time it's filled out, I get a notification via email and I see a summary of the information that's included in the form, right? Very helpful. So I can really see at a glance like what I'm looking at. And at the end of the funding request form, it actually says, thank you so much for submitting your form. You can expect to hear from me in 3 to 5 business days on next steps and whether I'm going to move forward, right? So I get the form, I review the responses, and I can quickly decide based on my decision framework that I created, whether this is something I want to explore, whether this is something I want to pass on, or whether this is something that I want to refer to someone else, okay? So once I decide that, yeah, I'm good to go, I want to move forward, I want to get more information, then I'm looking at the deal and I have my 3 categories, right? I'm evaluating the entity borrower. So typically that is a person's like LLC or corporation. I'm evaluating the owners of that entity, so those individuals. And then I'm evaluating the project, right? So if I'm in the fix and flip space, I'm actually looking at the deal, right? So my question should be such that the borrower has given me enough information about the project that I can run my own comps, I can do my own numbers, and figure some things out before I start requesting more information from them. Now, let's say I've done some research and now I have some follow-up questions or I have some documents I want to see. Then I will send an email to the borrower, oh, thank you so much, blah, blah. I'm ready to move forward. These are some documents that I'm going to need preliminarily, and I'd like to know blah, 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 right? Now, if the borrower already owns the property, there's one way that that's going to go. So if they've already closed, they already own it free and clear, there's one way this can go. If they are in the middle of acquiring the property though, then there's an opportunity for me to come in and kind of piggyback on some of the due diligence already done, right? I may want to look at the appraisal report that was done. I may want to look at the inspection report, etc. Okay. Now let's assume everything's good to go. I engage a title and escrow company. They make sure that title is clear. I'm going to be good in my lien position, blah, blah, blah. And then closing day comes. So typically a few days before closing is when you'll have to send the money, right? To make sure that when the title, your lien is recorded on title, that the funds can be dispersed. Okay. So you'll have to work with the title and escrow company to figure that out. Wire the funds. You'll, at this point, you'll already have arranged for signing everything, or you'll have signed everything already, notaries, whatever you need. And then the loan closes. Yay, everyone's happy. It's great. Now the borrower starts to do their work. Now, a caveat. Some private lenders structure their deals such that they don't give the borrower all the money at once, right? There is the option to have a draw schedule. So let's say I'm doing a $100,000 loan to a fix and flipper, and instead of giving it to them all at once, to mitigate some of my risk, I'm actually going to give it to them at intervals based on milestones in the project, right? I may say, I want to see, first of all, you come up with 20% to get the work started. And then when you get to this certain phase of construction, I want to take a look and see what you have going on. And then from there, I may disperse the second batch of funds, right? And then go on from there. Some lenders operate that way. Others say, okay, you need $100,000 for your project. Here's the full $100,000. And that's just an example, right? It's not always $100,000. I mean, sometimes it's $10,000, sometimes it's 15, 20, 30. It really just depends on the transaction. So you close. Now, how your fee structure is set up is really going to depend or determine what happens next. So let's say that you have a balloon payment or like a flat fee structure, and it's all due at the end of the project. Then after closing, there's really not much for you to do at this point. It's really about what kind of communication plan you and the borrower have come up with between closing and repayment. Okay, so some will agree to do like a weekly communication plan. Maybe the borrower sends you an update every Friday, or maybe you hop on a call, or if you're local, maybe you pop by the property, they give you the code, you can check things out. However you've decided to arrange it is between the two of you. But if you have a fee arrangement where they're paying on a regular interval, then you have to think about servicing the loan, okay? And that's a whole other situation because you're, tracking payments, you're distinguishing between principal and interest. And so some people hire a company to do that for them. Other people service the loans themselves, right? So you have options here. But depending on how your fee structure is set up, you may either be servicing the loan between closing and repayment, or you may just be getting updates and waiting, okay? Now, let's say everything goes well and you had let's say you had a balloon payment at the end and it's time for the borrower to repay. Typically, you've been communicating this whole time, and the borrower's like, hey, we got an offer, we're getting ready to close, but send me your wire instructions, right? This is where you already have this laid out. You have your wire instructions ready. You've instructed the borrower to call to verify. The escrow company will call to verify. And then the loan is paid off, and typically you sign some sort of release, releasing the lien on the property. The escrow and title company can help you with this as well, or you could do it yourself. But once that's done, you get your repayment, you handle your bookkeeping and your accounting, and the lien is released, and that's pretty much it. That's the whole process. That's with a real estate loan for a fix and flip project, right? And that's very specific. So if you did something like an equipment loan, your process may be totally different, right? Instead of filing a lien with the county recorder's office, you may be filing a lien with the Secretary of State. Your due diligence might look a bit different. Things may change depending on the type of loan you're doing. And if you are doing a 30-year, 20-year, 15-year financing system or structure for a property, then that's also going to be a totally different situation, right? So that is a private loan from start to finish for a direct lender, someone like me and you, a solopreneur in this industry, not someone who's pulling funds, someone who's loaning their own money directly, right? So understanding your lending box, meaning what kind of loans am I doing? Where am I doing them? What is my max loan amount? What's my minimum interest or profit, etc. Understanding those things up front is really what's going to help you understand what does the life cycle of my loan type look like? How do I prepare for that? What do I need to have beforehand? Who do I need to hire? Who needs to be on my team, etc.